when someone moves on in their 30s and 40s, is the choice of products going to be different for these set of individuals? You did mention that, salaries or, business income might go up, which would mean additional increase in SIPs. How would those individuals who are in their 30s and 40s should plan their retirement, and what kind of products should they choose, or what kind of combination should they go for?
Okay, simply put, Shumana, for a salaried person today, every month the PF contribution that is actually going into a fixed income instrument. While the government is giving a good rate of interest on that, but one has to appreciate and understand that's fixed income. Okay? That's debt part of the portfolio. So any incremental savings over and above PF must find its way into equities systematically. So there is no doubt, no asset allocation, no matrix that needs to work on. So, and an average Indian saves 30% of his income, as we know. So, if your PF, say for example, you yourself, you are salaried, so your 12% of your basic contribution from you and 12% from your employer makes it about 15% of your gross income will go into fixed income every month. So now if you're an average Indian and you say 30%, so the remaining 15% must find its way 100% into it. And if you can do that even for a period of 3 years or 4 years, market volatility will average out and you will get better returns than any fixed income. Now, any Indian or any for that matter, any human being would have two large needs: children's education and retirement. Baki, you can all manage. Okay? Those are non-discretionary needs. Those are discretionary needs. Non-discretionary you can't play with is your children's higher education and your own retirement. For your children's higher education, a child's higher education will come in about 16 to 20 years. Again, enough time horizon for equity investments. And retirement will be coming after 30 years and will play for another 30 years. So a lot of money should have to be parked in equity today. Now the question will come when you have retired and you do not have a cash flow. You now have to withdraw your cash flow from the portfolio. Then you think of reducing a part of the portfolio, keep your next 3 years cash flow into fixed income so that market volatility does not affect you. But at your accrual stages of your life, just don't get swayed by anything. Just put all your money, all your money into SIPs, into diversified equity mutual funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.